Welcome to EB-5 Investment Voice, where attorney insights intersects with immigration investments. If you are a foreign investor, domestic fund manager, or enterprising entrepreneur and want to get the most out of the EB-5 program, you have come to the right place. I'm Mark Deal, and I'll be your co-host on this journey. I'm joined by your host, Mona Shah, and other attorneys at Mona Shah & Associates, as well as immigration leaders from around the world. So let's get into EB-5 Investment Voice.
Hi, Mark. You know, Rebecca and I have been receiving a ton of requests about this particular topic, which is, why is there such a difference in interest rates amongst direct pooled projects? And we really considered for a long time who would be a good speaker to come on and give us valuable advice pertaining to their knowledge. And it was, to be honest, it was really difficult because we really wanted to find someone who was not only professional, but had seen a wide range of projects.
Yeah, so Mona, the reason why we have Bernard joining us today is, we wanted someone who wasn't biased against a certain project. Bernard has seen so many throughout. And I think it's important for investors to understand the different interest rates or the rate of return to investors. Why are some lower in certain projects? Why are they higher? And what we should be looking for in each of these direct projects.
Yeah, I get it. Investors are probably wondering, is this interest rate too low for the amount of money that I'm putting in? Or maybe this interest rate is too high or seems too good to be true amongst all the other ones. And maybe that's the case. There is such a wide variability in interest rates. So it makes sense for us to devote a whole episode on this topic and really explore that. And that's why today on this episode, we have Bernard Rojano. Bernard is the founder and principal consultant at Xecute Business Solutions, where he provides expert opinion, business modeling and planning, mergers and acquisitions, project development and management consulting to foreign investors, immigration law firms, U.S. project developers, and again to us here on EB-5 Investment Voice as a returning guest. Bernard, welcome to the show.
Thank you. Thanks, guys, for having me.
Bernard, one thing I do really appreciate about direct pool projects is that you can be in any industry, in every industry. And I think you've seen a lot of different types of projects.
Yeah, we have. So we started documenting and writing business plans for direct investment this is our 14th year. And we've had the opportunity to see quite a few different projects over the years. And so, yeah, we have a good sample, if you will, of many different projects in many different industries with structures of all types.
Right. So we are getting this question all the time as to, this project's giving me 5%. Why shouldn't I go with this project at 5%? And why should I go with another project at 2%? Rebecca, I think, first of all, people should remember what the average amount was under a regional center project when it was at the 500 level.
Yeah, I think a lot of investors get confused as to, when you're looking at interest rates, regional centers were low at that point. I mean, they were looking at 0.5% to investors on the...
Even less? We've had even less, 0.25%.
Yeah, on the investment. So it would be 500,000. And a lot of times investors need to realize it's not really feasible to give a higher interest rate.
Well, again, it depends. I think this is really what we all want to discuss today and where we really need Bernard's expertise, because some projects, it isn't feasible. Some projects, which maybe it is, but that money's gone to a middle person.
So, Mona, why don't you and Bernard tell us a little bit about why interest rates or the rate of return is much lower for investors in some of these direct projects that we've seen versus other projects?
Sure, Rebecca. I think, Bernard, the first thing I will say is that we have projects that are getting bank financing at maybe 4% or even less. So for that particular project to give 5% to an EB-5 investor makes absolutely no sense.
Correct. Well, what we see that may be helpful is the structure of the projects. And I think we put them in two categories where it makes sense. One is, for direct investment, projects are sometimes sponsored by a family or friends. So the investor is investing with a family member or a friend that they know, that they have a relationship with, and they're starting a new small business, example. And so in those cases, when they deploy their capital into the project, make their capital contribution or their investment, if you will, they basically get a partnership interest in that business. And at the end of the year, typically there is a distribution if there is any profits. So if the percentage of ownership is equal to the distributions, that's what they get. And that typically will be much higher than a passive investment. So the second category that I would mention is a more passive investment. And this is one where the sponsor that's in the US developing the business is likely pooling investment from multiple investors and or seeking one investor to fill their capital stack to fund a larger project in which they have quite a bit of equity and or they're guaranteeing the debt. The way that they look at the investor's investment is basically as a loan, not structured as a loan, but basically a loan. And in those structures, then the investor has very little risk. Of course, there is no guarantees. There cannot be, for the investment to qualify for the EB-5 program. But those are the kind of projects where we still see interest rates or rates of return, like Rebecca mentioned, that are similar or near what we would find within a regional center.
So, Bernard, before we get into the structuring of these direct projects, I think that was what Mona and I were thinking that's important, is to understand first, why are these direct projects using EB-5 funding?
That's a good point, Rebecca. In fact, I think that's one of the first questions, and we've discussed this on our podcast many times, as to why somebody would want to use EB-5 capital. And Bernard, for you, the first point that you're making on the friends and family, I know that person may typically get more money as far as interest rates, but there is also an added risk because they're doing a profit share, which is different from the second type of structure that you mentioned, which was a business looking for soliciting EB-5 investors and really giving them just a small piece of interest.
Correct. And so I think what we see from sponsors that are seeking investment is that they look at EB-5 because that is a source of equity that does not require them to give up an interest most of the time, meaning a working interest or a partnership interest in the project itself. So they can structure it, they have flexibility to structure those funds and to deploy them into the project and to pay back the investor for their return and interest, a fixed interest rate that could be based on profitability, obviously, and other triggers, but they commit to paying them a certain percentage of return annually. Now, why would they pay a 4 or 5% if they can get a 4% institutional debt loan? Is that most of the time an institutional debt loan is on top of equity, meaning that there is in the capital stack, there's a percentage of equity already committed for by the partner, so the sponsor. And then the bank places the debt on top of that. Most banks will not issue debt unless that there is equity or value within the business. And so equity typically in the market is a double-digit rate.
Yeah.
So if you go out and you raise equity, and so EB-5 can be less expensive and much more flexible for a business owner. So it's a very, very good source of capital for them.
Yeah, it is. It's a great source of alternative capital for so many businesses, which really would have faced double digits if they went to conventional financing. But going back to whether someone is confused as to whether or not they should go into a project, Bernard, which is giving, say, 5% as opposed to another project giving 2%, I think it's important to also remember that in the regional center context, we often saw 0.5% and 1%.
Yeah. And, what we see that triggers that is that in the case of a regional center investment, we would have a very structured, institutionalized, mechanism to deploy the capital, which was a private placement memorandum with an instrument, which would be a debt, a promissory note or a loan. which guaranteed that interest rate and the repayment to the fund, which is where all the investors were pooled. So that complexity and that structure allowed the developer to pay the lower rate, and it made the investor comfortable that they were going to get their capital back and that rate would be paid. Versus a direct investment that may be not structured that way.
No, Bernard, we don't agree. I think Rebecca is going to jump in and say, we've been advising everybody to have a private placement memorandum. If you are going to solicit investors, you need a PPM. Just because it's direct, it's not that you don't have a PPM. Rebecca, you have...
100% agree.
Yeah. And
go ahead.
No, I was just going to say that you misunderstood me. I wasn't saying that a direct project should not utilize a PPM as the documentation process to bring their investors in and it's for disclosures and obvious reasons. I was just mentioning that most, if not 99% of regional center projects have a PPM versus direct projects, which not that high of percentage will have a PPM if they have pooled investors. Example is if they have one or two or three investors.
Let me just go off of what you're saying, Bernard. So I think now as the direct program, right, because before the direct program wasn't as popular, right? And now that the regional center has lapsed, we're seeing more and more pooled direct projects where these developers are soliciting investors to finance their projects. So now we're going to see, I think, moving forward, and what we're advising is to have PPMs for these direct projects. So we will see an increase in that. But to bring it back to what we were discussing.
Well, Rebecca, even if there's only one and two investors, I think that's the point that Bernard is saying. Yeah, I would say yes, Bernard. Even if you are soliciting one investor, first of all, for the developer themselves, it's protection. But at the end of the day, there is a disclosure requirement. So I would say even if you had two investors, you need a PPM, and we are doing PPMs for projects and seeing them.
We've had a discussion on a previous podcast discussing PPMs and what we should do. And especially if it's just one or two investors, what we can do with the PPM. So it doesn't have to be an extensive PPM either. There should be something in place if you're soliciting investors.
Well, I understand where you're heading, Bernard, but I would feel that most of the time when in those larger regional center sort of projects where you're raising capital for maybe 100 investors or so, there were a ton of middlemen involved, which you perhaps are not seeing in the direct context.
Yeah, there definitely is not. We don't deal with the agents overseas, which even us that we document the projects and, our function doesn't necessarily require us to be in touch with any agents or anything. We typically interact with the lawyers like yourself and the law firm and the client and sponsor. But we do see that there is not that involvement like there was in the regional center program. And so, yes, I think you're right. I think that decreases the cost of the offering for the sponsor, which in turn is not carried over to the investor and therefore increases that return.
Yeah. I would also say that the other reason that we are seeing a different type of interest rate in direct pool projects is the nature of the business, because it has to be operational to be direct. And I defer to you, Bernard, because you've done so many business plans for so many different types of projects. In operational projects, you see more revenue, and therefore you can perhaps produce more interest. Or is it the other way around?
No. I think that is an excellent point. And you've noticed something that's important to mention, and that is the Regional Center program has been utilized for as long as we've been involved, mostly for construction activity and projects that are real estate development projects. So a large percentage of those funds have been deployed to that. And so those projects don't recognize any revenue for a long period of time because they're either selling or renting or whatever it may be. And the project has to be built, and that takes several years. And so during that period of time, they cannot afford to pay high rates, and they just don't have revenue. They don't have cash flow. And you're absolutely right. So when we're dealing with the direct investment program, there is no way we can count construction activity in most cases. Very seldom can we. And there is direct jobs that are created through operations of the business, and that business has cash flow. And that cash flow allows that business, in some cases, some of these businesses stabilize quite quickly, sometimes year one. And so they have the money in hand to be able to pay those investors a return a little sooner than, say, a construction project. So that's an excellent point. And yes, we do see that.
Yes, I think it has to do with the industry as well and the type of business, right? To be able to pay back or even to be operational in the first year. I mean, realistically, any project or even anyone who's going into their own business, it does take, it could take up to even 3 years to stabilize, right?
Yeah. And so that's another excellent point, because people are asking, well, why are they paying me this money? What you should be aware of, and investors should be aware of, is if somebody says that they will start paying them year one a return, and they can clearly see within the financials of the project or the business that there is no stabilization and that they will not make a profit till year three, because where is that money coming from? And it makes no sense.
Exactly. Mm-hmm. But there are projects out there, and I'm kind of very suspicious, which are really suggesting high interest rates. I'm talking things like 12%, which just doesn't make sense in the ordinary course of business, let alone EB-5. And I'm wondering, Rebecca, if people are confusing, or even if developers are confusing the rates of return with perhaps interest on net profit.
Yeah, I think a lot of investors are confused on that part. And I think it's important, one, and that's why you have a PPM and you have those documents to read into, so you understand what is your rate of return or how are you being repaid ultimately at the end. But yes, there's two types of repayment, right? You have your rate of return on your investment of the $500,000. So it could be a percentage of that, or it could be a percentage of, like you said, the profits.
Net profit return.
Profit return, that's right. But Bernard, aside from the higher, the start of the revenue, a lot of people are hesitant right now with the direct program because they feel that they're more risky. We personally don't feel that every direct project is more risky. We feel that it depends. But we'd like to know your opinion on this.
From my point of view, I think why investors are looking at it that way, and you're correct. That is exactly what they look at a direct investment project and they think, well, it's riskier. And it's because a real estate project is not depending upon revenues or startup. And the uses of the funds, this is critical to this question. The uses of the funds are for construction activity, and it's being deployed to build an asset of value. And on the side of an operating business, the uses of funds are typically a cash burn, meaning operating capital, or you're buying assets or a CapEx, which means that the capital goes away and is completely at risk with zero to no assets behind it in a lot of cases. And so that burn, because you're paying employees and you're paying operating costs and you're carrying those months of that stabilization Rebecca was mentioning that could go into 3 years.
Yeah.
Right?
So that's why people do have that feeling that they are more risky. But generally speaking, even though that is what you're seeing, the revenue or the project itself has less risk, or it is the same as a real estate.
Everything has risk.
Yeah.
They both have risk. It's just different. And it's the appetite of the investor and their understanding of that risk. But they're both completely at risk. And real estate goes bad just like a business does. So I guess my point of view is there is no higher risk with a direct investment if your due diligence is properly done or conducted. So I think it's the same. Today, it is the only choice our investors or our clients have. There is no regional center choice. If you want to participate in the EB-5 program, you have one choice, and that is to do a direct investment. And so you have to conduct your due diligence. And if the project passes your due diligence, I don't think it's any riskier than an EB-5 project. Than a regional center project.
Yeah, true. But not all projects are viable as a direct project, as we've seen. I know a lot of hotel sort of real estate projects, condominiums and all that, they're trying very hard to find a way to bring in direct capital, but it doesn't work.
Yeah, we have the same concern, and we try our very best to communicate to developers and the fact that within writing the business plan, we need to focus more on the execution of the job creation and timing of that job creation for the benefit of the investor. And we find that a lot of sponsors are over optimistic about the jobs they're likely going to create.
Oh, yes. Oh, yes. Yeah. We've seen 10 jobs, no problem.
Yeah. And the timing of that creation.
Yeah.
And meaning that they think they can create the job sooner than they can. And we find ourselves in an 829, which is the second application for the removal of conditions for people listening to this that don't know what that form does. But when your firm, Rebecca and Mona, goes through that process with a client, you know what you have to do. You have to prove up that those jobs were created. And I think that that's what we need to focus on, and the due diligence of that investor in choosing a project needs to be very, very focused on, are they actually going to create those jobs? And do they have the discipline, to report upon those jobs? That was a lot easier and simple in the regional center program than it is in direct.
Yeah. Mm-hmm. Well, there's two sides to that. I agree that it is easier for the disciplinary side of it, for the job creation under a regional center, because you have your economic report, which does all the work. And we have seen it over and over again in a direct project. If the if the developer does not need a full-time job, they'll put a part-time job in if they make more dollars and worry about it later. And we have to tackle that issue at the 829 stage. But what Rebecca and I have also seen is that some industries are natural job creators. And where there's a natural job creation, they don't have a problem in producing jobs. It's where you have to force the job creation.
Yes, exactly.
I totally agree. I think a lot of projects are trying to fit a square peg in a round hole, with direct investment. And so basically, you're right. I think that it's really almost something that you can easily look into is those industries that do create jobs. And you can tell when a project is reaching or stretching in the employment that they will create. And so that should definitely be a red flag for the investor. And I tell you, Mona, we advise sponsors about this. Of course, we are hired by the sponsor and we write what the sponsor wants us to write. And it is a plan, and we don't ever know if it's going to happen or not in any case, right? There's always a chance that they may execute or not, or may be able to run the business as they say. It is, after all, a plan and its future, yet right? And it's obviously at risk. But we try to explain to them that reaching and stretching the jobs and creating jobs or positions and job functions that are not necessary for the business is troublesome and will create problems in the future for them and their investors.
Right. Yeah. And Rebecca, I think you had a real point earlier when we were suggesting that with such high interest rates, you're taking away valuable capital, which could pay jobs and things, right?
Yes, exactly. So you have to be careful with the high interest rates, because you need to make sure that your business is operational and will continue to operate in order to pay you back your $500,000 plus your additional interest later on.
Yeah, as Mona's mentioned before, like 12% would be an example of a really high interest rate for EB-5. But what's a good interest rate range? What should people be looking for?
Really, it depends on the industry, Mark, but if some projects are getting bank financing at 4%, they're not going to give you more than 2.5%. And quite frankly, from the maths that we have seen in the finances, we've seen a range between 2 and, I would say, 3.5, 4, Rebecca? And we would say that on average, it is 2.5% is like a sweet spot, which isn't that different from a regional center context. It's just that a lot of sensible projects want to maintain their cash flow because, cash is king, especially when you have to pay direct employees.
Okay. So right around what the prime rate would be sounds reasonable.
2.5%, 3%, I would say.
Okay. So a little under prime.
Yeah. 4% you're looking at, you're cutting. If you're finding more than that, I know a lot of investors would come to us and say, oh, I've seen a project with really high interest rates. And you're like, well, you really do want to look at their financials to be sure that they can pay that. And then you also look at the capital stack. Who else do they have to repay? How many investors are in this project? I think all that's important to look at.
Yeah, I think our advice is always not to sacrifice your return of capital or the ability to create jobs for a higher interest rate.
Mm-hmm.
And I think, the sponsor they take on a lot of it is 98% of the responsibility because they develop the business, they operate the business. And in most cases, there's personal guarantees. There's a lot of exposure for the sponsor and the investor. At the end of the day, they're just providing capital. So they're not going to be taxed by the project in a way that warrants a higher return. So it's a fair return considering that it's just passive.
Yeah. And I've seen, we've spoken to some projects where they can get a bank loan for such a low interest rate. And if I was an investor, I would really think about looking into that project, because if they have the ability to get that loan at such a low rate, that means they're doing something like the bank is willing to give this to them and take a chance with that project, right? Or they've had success in the future.
Rebecca, I think, again, it's the industry. I think you can say that for sure, but I think some industries where there's there's an asset behind it or something, they can do that. But I don't think all industries are the same. And sometimes it's not quite fair to basically put the riskiness of the business on whether a bank loan is there or not, because that's not always the case.
No, I'm not saying that there is a bank loan, but if a project could end up getting a bank loan for that, it means that, the banks are looking at it in a...
If it has a diverse capital stack, as you were saying before, look at the capital stack. If there's institutional investing, maybe there's private non-foreign investor investing.
Private investing, Mark. But we often found, I remember when we used to do all of these discussions in China with agents, and agents would look at independent indicators of how good or bad a project was. And they would often look at the banks as an indicator, but that's not always the case.
Yeah, exactly. No, I'm not saying it's always the case, but I think it's just one of the points to look at.
Yeah. And what's interesting, guys, is this direct investment, I guess you want to call it rush because of the lapse of the regional center program. We're only really, 60 days into this, right?
Yeah.
Now we're heading into 90 days. And so 1/4 of the year, people have been rushing to develop projects that qualify for the EB-5 direct program. And so the trends are a little bit hard to read because there isn't that much activity that has taken place just because of time. Now, yes, we're all busy and there's a lot of people trying to participate, but we had 6, 7, 8, 9 years of the regional center program to set trends and to figure out what pays and what's fair and what isn't. And so this is difficult for clients and investors to navigate through, and they need assistance. They need people, they need to pay attention to the fact that having a good advice, I think, and good due diligence and surrounding themselves with people that give them, opinion is, I think, of greater value now than ever.
I agree, Bernard, but also, direct is not something which is new. That was the original EB-5, and it's still here, even though the regional center program has lapsed. I feel like the rush is more because people are trying to get in right now at the 500,000 level, and they're worried that either USCIS will have won their appeal or change the regulations, or there'll be some legislation through there. But the thing is with the direct program is that there are a ton of people who, unfortunately, as you cornered it before, are trying to squeeze a round peg into a square hole because they are not understanding not just the structure of how this is put together, but some other nuances, which I know we are going to talk about in other podcasts.
Yeah, so Mona, for instance, we will be discussing at a later podcast the purchasing of an existing business and how to restructure or reorganize it as an EB-5 project.
Yeah, one of many other topics I had. But these are not simple areas. And I think, they're not. And I think that people should take them seriously if they do really want to invest in EB-5.
Yeah, there is no question that none of us have a crystal ball and that we do not know when the regional center program will come back online and the lapse will be over. We're confident that it will come back. We just don't know the timing. So there could be many, many, many months ahead of us with no regional center program. So if you are interested, or if you have anybody that's interested in the EB-5 program, their only choice is direct investment. So this is what they need to be aware of. This is what they need to learn and take in consideration. And it is their opportunity to participate in the program. And obviously, we have the benefit of the fact that the rate of investment has been lowered to the 500,000, and that we know for sure is available. And so I'm not sure that the right decision is for anybody to wait to see what happens with the regional center program if they are interested in an EB-5 visa.
Well, Bernard, I couldn't say it better than that. So thank you for being on the show today.
Thank you, Bernard.
It's my pleasure, guys. Thank you so much for having me. I really always enjoy this.
We hope to have the privilege of having your expertise again in the future.
You can count on it.
Thank you for being with us today on EB-5 Investment Voice. The topics presented in this podcast is informational in nature and is not to be taken as specific legal advice. If you have questions on the topics presented in this episode or other investment immigration needs, please contact Mona Shah & Associates. Mona and her attorney staff can be reached at mshawlaw.com. That's MSHAH law.com. Make sure you don't miss our next episode focusing on a different aspect of the EB-5 program by subscribing to the podcast. While you're at it, leave us a rating on iTunes. If you really found this episode valuable, share it with someone else that could benefit from this information. Until then, I'll see you on the next episode of EB-5 Investment Voice.